Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets where we saw a major downturn the last 2 days of the week. He tells us about the one positive place in the markets. He also has a special offer for our listeners. Tim, Cycles Van Wood, warns his Dow theory alarm bells are going off, and he tells us why you should be ready to deal with a major correction. Founder of the TrendLetter.com, Martin Straith digs into the background that saw major players in the stock market give up a lot of ground this past week. If Nvidia falls below a certain set point, it could take a lot of stocks with it. Calling in from San Diego, Robert Campbell from the Campbell Real Estate Timing Letter tells us what's hot and what's not in the U.S. real estate market and whether the housing bubble is about to burst. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always enjoy the opportunity.
Do we have a special offer for our listeners?
Yeah, at the website, chartsandmarkets.com, there's 25% off for new annual subscribers. Also, there's if anybody wants to come in and just have a short-term look at it, we give them 2 to 3 months of observations of the work that we do for $200, and there are various times in the year where you want to take advantage of opportunities that just jump out at you, and this last few weeks have been the beginning of something that looks pretty darn significant, especially with the work that we're doing.
The stock markets had a bit of a meltdown, a big meltdown. How would you describe what happened the last 2 days of the week?
This has been in the cards for a while. When we've talked about excesses on the upside, markets usually don't top on a single spike high. They tend to create a high like we had with the NASDAQ and things like Nvidia a month and a half ago. And then they come back around and they retest the resistance, and then that becomes a distribution pattern. And once the distribution is in place, then things start to get heavy. And this week with the initial moves, comments from the Fed was enough to give a bit of a spurt on the upside midweek, but the employment numbers at the end of the week are just terrible. So, the probability, everybody's now talking about, an aggressive easing cycle as far as interest rates are concerned. But, we look at some pretty big models. I look at that 100-year upward channel that the markets have been in. We've done the perfect test at the top end of that channel in the last 2 months at the 5,400 to 5,600 range on the S&P. The 2 previous times that it's been at the top of this channel, it had the same style of pattern that we're seeing in here right now. So the sort of the chicken scratches, as I look at them, are really defining themselves quite nicely. The initial break into a week ago, and then the Fibonacci retracement rally this Wednesday were just perfect in terms of setting up for another leg to the downside. The same thing over with the 17-year cycle that we've been watching. That one was, so this is the fourth example, or no, actually the sixth example, looking at that pattern. And the initial break now was anticipated to come down, test the 100-day moving average and the April high. And as of the Friday, we're doing just that. The 100-day average has been tested. We're down just within a hair on the S&P of the April highs. And as we know, the NASDAQ and the AI stocks, they've been rolling over. You know, and this is so indicative of what happened, say, back in 2000 when everybody had the hype on the .coms. And the question was, you know, everybody's pouring money into a sector and ending up then with it being a long time down the road before you actually see any earnings at the bottom line for most of those companies. And so here we are. The sector's getting heavy, and it's not surprising. And over on the, you know, looking at the credit side of the equation, the bond market is just on the long bond, the U.S. Treasuries, having a great move on the upside. So, you know, the capital is moving around from the big growth stocks and big growth era into places of value. It's a bit of a scare out there when we take a look at the credit spreads. We look at the CCC spread. That looks at high yield corporate debt and compare that to the U.S. 10-year yield. So that is the risk-free side of things. And that spread produced a really good buy signal back in the bottoms in 2022, October 2022, and preceding sell had been in November of 21. Well, right now, that CCC spread is coming around, has been giving some warning signals for the last couple of weeks, and it looks as though it's ready to break out. If that happens, it'll be the first sell signal that we've had out of that index since November of 21. That is not just short-term, but at least intermediate-term bearish as far as the equity markets are concerned.
What's going on with gold?
The gold market, a bit of a flight to the quality there in the last couple of days, did punch up against the all-time highs again. It was looking pretty good up until the middle of the day on Friday, but just couldn't hold the big gains. And that's surprising considering how weak the U.S. dollar was on Thursday and Friday. Dollar index down a full 1% on Friday. The index now down to 102 and change. And we look at a 58-day cycle in that one, which has rolled over on the dollar index. That probably doesn't look to have a bottom until the latter part of August. So that would be supportive to gold. And in this case, it should do a little better than it has as of Thursday and Friday. The dollar index, put in sort of, it's also had a bit of a rolling top. On the move up a couple of weeks ago, we got some nice sequential sell signals. Those tend to happen about a week to 10 days before the top, and that's just how this one has unfolded. So, everything here in this last couple of weeks has been an evolution of things happening, not just one-off events. It's a series of them. So there's a fair amount of potential. And in terms of the equity markets, as say, we've come down to the April highs right now. If we don't hold those April highs, and I'm expecting that those will eventually break here, we've got some really good support areas underneath there from which we can look for a bounce, and that could. But I think the August is going to be a tough month. Probably the second part of the month might have a bit of a bounce. and we've got some really nice parameters to look for in terms of upside potential on that bounce.
What's going on with crude?
Crude just is having trouble. The oil market just does not have any life in it right now. Down in the $72 range, probably is. We got some oversolds a week ago. Couldn't get any kind of a decent bounce out of it. And if we take a look at the mines, metals area, and then industrial commodity sector. So the oil market just fits in what we see happening in copper as well. The price of copper oversold a couple of weeks ago, bounced for a day or two, and that's it. The gold to copper ratio showing really big movement here. Indicative of slowing economy, and that becomes then all part of this distribution for broad markets.
Was there any positive territory the last 2 days?
The positive territory is in the government bonds. The yields, as far as the 10-year yield, is down to 381. That's the lowest of this year. The yield curve is steepening, so you're seeing the front end of the curve dropping down in terms of rates. The bond market, our model, we saw a nice, a big exhaustion capitulation low last fall. Tested that in this spring, and it turned the corner. The intermediate term moving averages turned to the positive side just here a couple of weeks ago. This thing's probably got room on the upside. So the long bond is maybe in the 5 to 10 year time frame. In terms of looking at durations on the bonds, that's a pretty good place to look at. Another one that's just been hammered down here in the last little while has been uraniums. So starting to see the first oversolds there, not getting any outright signals as of yet, but definitely going to put that on those on the watch list for the next couple of weeks here. There might be a pretty good bounce, but patience will be necessary to wait until we get the right oversold readings to participate in that.
Ross, thank you so much for the update. And again, can you tell us where to get that special offer?
The website is chartsandmarkets.com, and there's some samples there too. If you click on the Contact Us section, there are some items that we can send off to you, and you'll have a chance to see our work.
Ross, thanks again.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Tim Cyclesman Wood on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He's speaking to us from Alabama. Welcome back to This Week in Money.
Jim, thanks for having me.
Tim, the numbers that came out of the stock markets on Friday, alarming to some. You say there's a number of things in there that you saw being set up all the way to last August, where your newsletter was saying we're going to see this happen with interest rates. This is going to happen on the stock market. And now what has happened on Friday seems to be the culmination of this, a kind of, hey, folks, time to keep your heads up because we're into, quote, interesting times, unquote.
That's a loose interpretation, yes.
Yeah.
I have been watching And I've made some discoveries with some long-term cycles, some long-term economic cycles, and some underlying other economic data that I have found. And like you said, I knew last August that top was not it, and that we would go higher. And then I knew that, when we got into the March-April high, that top was not it, and that we should go higher. And my thesis has been that this isn't the entire story by no means, but I thought what we would see was the market continue higher into the rate cutting cycle. And I've been tracking the rate cutting cycle with some matrices. I've been saying that we are not there yet, and there are some pretty hard cut. Measures for what we need to see there, and like I said, that's played out very well. Known that the top was in interest rates and the cut were still ahead. Anyway, the Fed has been dangling that interest rate cut, the first cut in front of the market's nose all year. I mean, that started back in January. People may not remember that. I've watched it, all along. And now, based on the structure, I mean, there's some things that are not in place. You can't make a major call on one day, but there were some developments this week that tells us that we're now in the minefield. And, my expectation has been pretty much all year. I've written in the letter that I thought we would go up into the third quarter, but I thought that it would occur with the rate cuts. And we have not seen those cuts. So I'm thinking at this point that the market may have already discounted those cuts. We'll see. But with the developments of this week, it may be that that is the case. And so I have, for the record, I have some intermediate and slightly higher degree cycle lows due in October. I think that we have seen those intermediate term tops, and we're headed down into that time frame ahead of what looks like it's lining up to be ahead of the election. And then I look for a rally out of that intermediate term low. It just coincidentally is lining up to occur around the election time. And then that's going to be the ultimate telltale sign. I suspect that is probably going to be a failure. But we'll see when we get there. There's a couple of things that I would have liked to have seen with the developments this week that I didn't see. But on balance, this is a warning call. This is serious. The cyclical setup that we've entered into. So we'll have to see how it develops.
So it's not time for panic stations yet, but maybe have the life jackets and lifeboat prepped?
I would have the life jacket on and my hand on the rope.
Yeah.
I mean, like I said, I'm not trying to speak out of both sides of my mouth. This is, I was, like I said, the market's never going to give you a perfect setup where you get everything you need to see. Like I said, there's a couple of things missing, and I need to see a couple of things develop. But on balance, it looks like that there's a very good chance that we've seen a major top in the market. And if that's true, then like we talked about in our last interview, it's not just a top. Or let me say this another way: the risk here is that it's not just a top like was seen in 2020 or in 2007 or 2000. The risk here is the unraveling of the long-term economic cycle that they've been keeping afloat for 20 years.
Tim, we'll keep an ear out.
Thank you for having me. And, we'll see how, like I said, we'll see how it develops. I appreciate the time, Jim. And if anyone's interested in the details, it's available at Cycles News and Views, cyclesman.com.
Tim, thank you so much for giving us the heads up here on This Week in Money.
Thank you.
My guest has been Tim Cyclesman Wood. As he said, you can subscribe to his service on Cycles News and Views on cyclesman.com. Coming up, Martin Straith next on This Week in Money.
Recyclical, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
My pleasure, Jim. Always good to be here.
Given the bloodbath in the markets as we're speaking on Friday, I think the last couple of times that you were on, you've been seeing a rotation in the markets from big tech to small caps, from growth to value. Is that rotation sustainable in today's environment? Yeah,
well, there was a rotation until the last few days, but you're right. I mean, this week has been a wild ride, and it's a bloodbath out there today and yesterday. I mean, looking at a heat map right here, it's just a sea of red. You know, unless you've been living under a rock, most of your listeners, I'm sure, are well aware that Nvidia has been the AI darling, that led the stock markets to new highs. Well, Nvidia just had its fourth bearish outside reversal since March 8th. And now, for those who don't know it, like an outside reversal is quite a reliable indicator of a trend change. And, Nvidia has now been in a downtrend since the June 10th outside reversal. So after those previous three reversals, we've seen pullbacks of 23, 18, and 25%. So yesterday it closed at its 100-day moving average, which has been, an important support level at 104. This morning it dropped below that, but it's trading at about 105 right now as we're getting close to the close. So if 104, so that 100-day moving average does not hold, Nvidia's next key support would be the 200-day moving average, and that would take it all the way down to 80. So, pretty drastic move that could be. So we got to keep our eyes open here. Now, Nvidia reports its earnings next week, so that's going to be really interesting because the market will be expecting another mind-numbing earnings beat, and if that doesn't happen, we could see the air come out of this AI balloon, and Nvidia at 80 would be a real possibility. So now looking at the rotation as we were talking, up to this week, the rotation to small caps, from around July 10th, when Nvidia had that third outside reversal, we saw the Russell 2000, which is the small cap index. It rallied up about 13% over the last month. But again, in the last couple of days here, we've seen the Russell sell off about 80% of that, 8% of that. So the rotation was growth, as you say, growth to value rotation. But what we're seeing this week is a total market crunch. Volatility has spiked from record lows. I mean, we've seen the VIX volatility index. Today it hit 30 at one point. And it was just 12 a couple of weeks ago. So, Jim, this kind of action, it really reminds me of the dot-com bubble in 2000. Back then, it was not unusual to see rallies, swings of about 8 to 10% in a day. So we need to keep our eyes out. Right now, you've got Intel just announced they're cutting 15,000 jobs, 15% of their workforce. Yesterday, we got the ISM manufacturing data, and it was bleak. Manufacturing was down 1.7%, new orders down 2%, production down 2.6%. Employment in the manufacturing sector down 5.9%, so almost 6%. That's 8-month lows for a very critical sector. So, the word recession is certainly back in play now. Volatility is great for traders, but I suspect most of your listeners are like many of our subscribers, and they're longer-term investors. So we need to be on alert here. If we see volatility start to rise like it did in 2021 at the highs, we could see a reversal just like we did in 2022, where the S&P gave up about 35%. Now, a big driver of that rotation we were talking about has been the expectation of a Fed rate cut in September. Lower rates affect smaller companies much more than larger companies, as they tend to have higher debt levels. So lower rates means lower servicing costs for these companies. So that's a bright spot for them. So next week's going to be very key. As I said, Nvidia reports its earnings, and that's going to provide the market with a lot of direction about the current AI expectations. And again, I'm looking for capital. If we do get that rotation, out of growth stocks, so out of the technology stocks and into value stocks. So you're talking those industrials and staples, etc. But if Nvidia fails to impress next week with its earnings, look out. We're likely going to see a general market pull back, sell off, and it probably will affect all sectors, because just like Nvidia kind of pulled all the market up, it could pull it all down. So, just like we just seen yesterday and today, it could get pretty volatile next week. Yeah,
as you were saying about Intel, massive layoff and no more dividends from them, and they fell almost 25%.
Yeah, things are, when the markets get spooked, things happen very quickly.
The Bank of Canada has cut rates by 0.25% twice now, while the U.S. Fed has continued to hold rates steady. Why is there that discrepancy?
Well, mainly there's some really big differences between Canada and the U.S. A lot of people think, Canada and the U.S. is pretty much the same thing. But, for one thing, the U.S. economy is much stronger than Canada's. Even with all the data that's flying around today and yesterday, Canada's data is much worse. So Canada's GDP data, so gross domestic product, is seriously lagging that of the U.S. And it's expected to be, less than half of the U.S. over the next year or two. Unemployment is rising much faster than in the U.S. So basically, you've got different economic conditions, different inflation concerns, and that's led to different rate policies between the two countries. Another key factor is, a really key factor, I guess, is, mortgage terms. In Canada, or in the U.S., the average mortgage term is 30 years. In Canada, it's 3 to 5 years. So that means that the average American who has a home and a mortgage that does not come up for renewal for maybe, 20, 25 years, they have not been affected at all by the dramatic, mortgage rate increases. But here in Canada, according to RBC, 60% of Canadian mortgages are going to come up for renewal between now and 2026. You think about that, at the current levels, those needing to renew will face, increased mortgages of 30 to 35%, according to RBC. And you think about that, a 30 to 35% mortgage increase, especially in areas like Vancouver, Toronto, other expensive regions. That's going to take a huge chunk of the monthly income just to pay off, pay those mortgages. So, that's put a lot of pressure on the Bank of Canada to try and give some relief to Canadian homeowners and, especially, those who are going to be up for renewal soon. So that's a really key reason why the Bank of Canada has been much more aggressive on rate cuts.
The U.S. Fed is expected to cut rates in September. In your last issue of the Trend Letter, you noticed that the latest GDP data that the U.S. economy is still growing. The Fed may even pause again in September. Can you explain why this might be possible?
Oh, yeah, it's a real toss, especially when, the data we've received the last couple of days. The data is so mixed there. The Fed focuses on two main things. They focus on inflation and jobs. And, the U.S. GDP came in at 2.8%. That's, much higher than the 2% expected. The Fed's favored inflation gauge, the personal consumption expenditures, that was revised much higher for May, up to 3.4%. And that was the highest reading in a year. So, they're a long way from their target of 2% inflation. Now, the U.S. economy, it's been in expansion for 51 months now. And then, of course, on the other side of that, today we got weaker job data. Like I said, we got the Intel numbers. And then in the U.S., you got fewer jobs and you've got higher unemployment. And then yesterday, we got the ISM manufacturing data. and that was very negative. So, again, we got really mixed data going here. So the big reason inflation has remained so much higher than the Fed wants is the massive government spending. When governments spend money and, they borrow and spend, that's inflationary. U.S. debt just hit $35 trillion. That comes out, that equates to $103,000 per person in the U.S. or $267,000 per taxpayer. The interest expense on the U.S. debt just reached almost $1.1 trillion over the last 12 months. So if that trend continues, it's, the debt servicing for the U.S. will soon surpass Social Security as the largest item in the federal budget in the U.S. A rate cut in September, it's close to being 100% baked in. But remember, the start of this year, baked in, we saw 6 to 7 rate cuts was supposed to happen. So the Fed's in a tough spot. The average American's hurting. Higher prices continue to be the number one complaint. Yet thanks to reckless government spending, inflation's still high, not dropping like they want. Now that inflation has started to slow, it's currently now at about 3%. But you have to remember, for the average consumer, inflation is compounding. So the recent 3%, that's on top of the previous annual rates of 4.7% back in 2021, 8.3% just, during COVID, and 4.2% 2023, and now the current, 3% in 2024. So you add that up. In the U.S., inflation's up 20.2% higher today than it was 4 years ago. And we all know that food and rent prices are even higher than that. So the big dilemma for the Fed is if they don't cut soon, people with debts are going to get crushed. If they cut too soon, inflation's going to, rise higher, and that's going to make the cost of living even higher. What we've got now is we've got stagflation, meaning we've got slower economic growth, we've got rising unemployment, and we've got inflation still too high. So consumers are spending less while facing this onslaught of higher prices, and it's making it tough on households. So I really don't think they want to cut rates and then have to raise them again because inflation won't come down. So the biggest problem for the Fed and, for the Bank of Canada, again, is the federal government spending. Both the Biden administration and Trudeau government, they're spending at outrageous rates, which is inflationary. And, the U.S. election's coming up. That's not going to solve anything because even if Trump wins, he loves to run up big deficits as well. So while the Fed could pause in September if inflation remains too high, but unless that's the case, I expect them to cut in September, especially with what's been happening this week. And if data remains weak, I could see them even cut 50 basis points. The threat of a global recession is right back on the front burner.
A few months ago, you posted a video showing that when the Fed cuts rates aggressively, that is not a good time to buy stocks. Can you elaborate?
Yeah. I think all investors need to see that video, see those charts. It's less than 10 minutes. You can access it. You can just go to our website, thetrendletter.com. There's a videos button there. You can click on that. You can see it. Because I keep seeing, CNN and these other Main Street commentators keep saying that once the Fed starts cutting, that would be a great time to buy stocks. And as the video clearly shows, history tells a much different story. The last 4 times the Fed aggressively cut rates, so that was in 1998, 2001, 07, and 2019. In each of those cases, the reason the Fed aggressively cut was because of economic crisis. We had the Asian financial crisis in 1998. Back then the Fed or the S&P 500, it dropped 20%. 2001, I'm sure most people remember the dot-com crash. Well, the S&P 500 dropped 50%. The NASDAQ fell 75%. In 07, we had the credit and financial crisis. S&P lost over 50%. And then we had, 2020, we had the COVID, we had a short recession, and the S&P, it fell about 35%. In each of those rate cut cycles, the time to buy stocks was not when the Fed started to cut rates. The time to buy was when the Fed stopped cutting rates. And when you think about it, that makes a lot of sense. in each of those rate cut cycles, the Fed started to aggressively cut because the economy was in serious trouble. Well, if the economy is in trouble, especially if it's headed for a recession, then that is not good news for companies' revenues. Therefore, it's not good news for stock prices. So what the charts show in the video is that the best time to buy stocks is, in the Fed rate cut cycles when the Fed stops cutting rates. So, again, that makes sense because why would the Fed stop cutting rates? Well, it's because now the economy is starting to recover. Each of those examples when the Fed stopped cutting rates, from 1998 to 2020, the stock market started to rally. After COVID, we saw a rally of over 110%. 2009, after the financial crisis, the stock market rallied 70%, and ultimately it moved from 2009 to 2017 to over 300%. The Fed stopped cutting in 2002. The S&P rallied, 50% over the next year. So again, if the Fed starts to cut aggressively, that means they are worried about the economy and a potential recession. Those conditions are not good for stocks, so the market would likely decline and probably decline quite severely. So if they do start to cut rates based on history, the time to back up the truck would be when the economy starts to rebound and the Fed stops cutting rates.
After setting a record high this week, what's your prediction for gold?
Well, gold's it's up checking here. It's up about 19% for the year. So, it just recently broke through its previous high at 24.40 in May. Today it's trading at 24.80, so it's pretty much right on its recent high. So the big picture for gold, if we kind of get away from all the action that's happening, all the noise today and this week, there's a real new awareness out there. Things have really changed. Since Russia invaded Ukraine and the West confiscated the Russian asset, that sent a message to all those countries that are not good friends of the West. So, we're talking China and Russia and Iran. So what have they been doing? They've been loading up on gold. China used to be, or it still is, but it's changing now. They were the second largest foreign holder of U.S. debt behind Japan. But in the last 3 years, China has sold off about over $350 billion in U.S. bonds. And what they've been doing is they've been buying gold along with Russia and Turkey, India, Iran. And so the gold action, that's suggesting now that, the central bankers that don't want to, they don't want to be owning U.S. bonds. They don't want to be propping up the U.S. dollar. They want to move to other assets. And it also is telling us that investors have woken up to the reality that all of these excessive debts the U.S. and all the other governments are racking up is killing the purchasing power of all these paper currencies. And that is key. So as we noted just a bit ago there, the U.S. debt's over $35 trillion. Their interest payments are almost $1.1 trillion a year. If we get a recession, gold should do well versus other sectors. So, the purchasing power of all these paper currencies is declining. So we're talking the Canadian dollar, the U.S. dollar, the euro, the yen, etc. So if you want to protect your purchasing power, then you need to own gold, Bitcoin, and eventually you want to own some commodities. And yes, I do see gold going over $3,000 over the next year.
What's your call for crude oil?
Well, there's some conflicting scenarios there. Oil's trading at, what we got, about $74 here today on Friday, so down about $2.50. So in the short-term bullish side, so for higher prices short-term, we've got, the current tensions in the Middle East off. Obviously, the killing of the Hamas leader and the Hezbollah military leader. So, what's Iran going to do about that? So that's hanging over there. We're seeing, hedge and commodity funds have been loaded up on long positions. You've got Ukraine have been attacking the Russian refineries, so that's, an issue for supply. We're in hurricane season, so, that can shut down a lot of the offshore drilling. And then if you look at the short-term bearish side, we've got weakening economies in a lot of the world, including developed countries, including Canada, U.S., and Europe. China's been struggling for quite a while now, ever since COVID. We're seeing Russia increasing production as they need to fund their war with the Ukraine. And then we got August, which seasonality says it's a bad time for oil. Now, short term, we do expect oil prices to struggle. If we do not see an escalation in the Middle East, then that could change. Also, recession fears globally are going to put some pressure on oil, and it could put quite a bit of pressure. And based on seasonality, like I say, that's weak for oil. I think we're going to see testing the low 70s. 67 has been a very strong support over the last year. So, keep an eye on that. If we ever do get back to that level, that might be a great buying opportunity. In the big picture, longer term, we got growing demand, especially in emerging countries. We've got 1 billion people in the world don't even have electricity. People seem to forget that oil is a major component of, all kinds of different things that we have in our daily life. Clothing, our computers, our phones, shoes, medical supplies. Everybody wants people to buy EVs. Well, those EVs have tires. They need them. They're going to drive on asphalt roads. Well, all of that has an oil component to it. So these are things that people in the emerging markets, they want and they need. So I don't see supply of oil going away anytime soon. And then on the supply side, we've got, lack of investment, capital expenditures are way down. Rig counts continue to decline. We've got governments globally, have a hate on for fossil fuels. So what have they done? They've increased the taxes. They've increased regulations. They don't allow new permitting. So it's a simple supply and demand issue here, an increase in demand, especially those emerging countries, and this global effort to squeeze supply. You're going to have a big supply problem in the next few years.
When you were on last month, we discussed how Bitcoin had dropped quite a bit down to 56 grand. What's your take on Bitcoin now?
Yeah, I think we talked about how, that big drop was primarily driven by that Mt. Gox, that defunct crypto exchange, and they were making repayments to creditors after they had gone bankrupt. So that whole, fear of a bunch more Bitcoin coming onto the market, that spooked the investors. I mean, realistically, Bitcoin and other cryptos are incredibly volatile. From September to March, Bitcoin went from 25K to about 73K. That's 182% in less than 6 months. Since that high, then it fell back down to 62K, and then we had that Mt. Gox issue, and that dropped it down to, like you say, to around 56K. I mean, that was a drop of 23%. So, we have a rise of 182%, and then we drop down 23%. Again, volatility is all over the place. But typically, Bitcoin moves similar to gold. It's affected by interest rates and inflation. It also tracks the NASDAQ tech index quite closely. And it also can be like a safe haven type trade with geopolitical concerns. So recently we've seen gold outperform both Bitcoin and NASDAQ, but I expect Bitcoin is going to continue to be volatile. And ultimately, though, it's going to do very well for people that buy in after these big, sell-offs. And like gold, with paper currencies losing purchasing power, Bitcoin should do well over the long term. But like gold and pretty much everything else, I mean, today it's down, just looking here, we're down $2,200, so over 4%. Longer term, though, buying the dips with Bitcoin and Ethereum makes a lot of sense to me.
What do you see for the U.S. and Canadian dollars?
Well, as I say, these paper currencies, they're all losing purchasing power. And the thing about currencies is that they're all connected, and it's really all driven by the U.S. dollar. So if the U.S. dollar is strong, and that negatively affects most other currencies, commodities, equities, and precious metals. When it's weak, then the others rally. So last week, we had the Bank of Canada cut its rate again, so that second time, so down to 4.5%. This week, the Fed kept their rate at 5.5%, so it's a full 1% higher than Canada. So investors, they're looking at that, and so that they see a big advantage to buy U.S. bonds which makes the U.S. dollar more valuable than the Canadian dollar. The key will be what the Fed does in September. If they cut rates and start an aggressive rate cut cycle, then the U.S. will decline. The U.S. dollar will decline. But it's all relative. I mean, if the Bank of Canada and the Bank of England and the ECB, if they all cut rates more than the U.S., well, then the U.S. dollar is going to be stronger than those other currencies. So overall, the general weaker economic data, the markets right now are forecasting a 100% chance the Fed cuts rates in September. I just checked it this morning. That 100%, 27.5% expect a 25% cut or 25 basis point cut. And now, as of today, 72.5% chance of a 50 basis point cut. So that's gone up dramatically over the last 2 days. So now there's also the Jackson Hole meeting in August. I think it's near the end of August, 22nd, I think, to 24th. And that's where all the major central bankers get together. And that's where Jerome Powell, the head of the Fed, typically tells the world what his plans are for interest rates and the U.S. economy. And, we also know that Trump wants rates lower. He wants a much lower U.S. dollar. And so I think that that's another element that could push U.S. dollar lower, especially if it looks like he's going to win the election. But longer term, we expect the U.S. economy to be stronger than most others. Again, it's all relative. And that means the U.S. dollar is going to be stronger. But we don't like any of these paper currencies. But it's really just a case of the U.S. dollar in the big picture being kind of that least ugly house on the block. So it's really important for investors to understand how all these things are connected. So, resistance for the U.S. dollar is at 105.75. Today it's 103.45. Near-term support is 102. For the Canadian, bit of a mixed bag, but again, it's all connected. So Canadian dollar has been trending down since it peaked in late December. As we just talked about, the Bank of Canada has been much more aggressive in reducing interest rates than the U.S., and so that means U.S. bonds are paying a higher yield. Today, the U.S. 10-year is paying around 4%. I mean, it's dropping, while the Canadian pays about 3%, and it's also dropping. So again, the U.S. bond's paying almost a full % higher than the Canadian. So the Canadian dollar is up slightly as the U.S. dollar is down, but I see any rally in the Canadian to be very temporary. Currently the Canadian's at 72.15. So now it's dropped below its near-term support that was at 72.50. Key resistance is at 73.60. So Jim, I suspect that we're going to see the Canadian dollar hit 70 or even lower in the next year. And as investors, we need to understand then things like the resource sectors. I think the Canadian producers are going to do very well because their costs are in Canadian dollars while their revenue is in U.S. dollar. So we're talking about, oil, natural gas, copper, gold, anything priced in U.S. dollars. With oil, we've got the new pipeline in there. So that's now reducing the discount Canadian producers are receiving. I think oil is going to go to $100 and likely higher. And I think the Canadian dollar is going to go to 70 and likely lower. So, that's a positive for a weaker Canadian dollar. And I think those Canadian producers are going to make a killing over the next year or so. Now, obviously for the Canadian consumer, a weak Canadian dollar is not good news. You can't travel as well. We were just in Europe a couple of months ago. The euro is 50% higher. And it also means for Canadians, the cost of imports will rise. And, for essential items like food, those are going to be more expensive.
The yen has been on a tear. What's driving that?
Yeah, Japan has been such a wild story. It's the third largest economy in the world, yet it's been in a deflationary environment for decades. Japan has kept their interest rates low to encourage inflation. Remember back, we have to go back, from 2012 to 2020, every country was doing the kind of same thing. The U.S., Canada, Europe, most of these countries the economies were not growing. So all these central banks are, lowering the central bank rates, trying to encourage, the economic growth and inflation, which was hovering near zero. Then we had, Canada, the U.S., and most of the developed countries then experienced a rapid rise in inflation because of all the the COVID lockdowns, supply chain shut down, and then all the stimulus money that was sent out to households. Well, Japan did not experience that inflation. Japan is, was much slower to lift restrictions, which limited inflation. Another key factor is, Japan's got lower wages and they have weak consumer demand. But by keeping rates so low, it's really affected the yen. I mean, the yen, we've been publishing, I think we talked about it quite a bit on your show here. It drove down to about 35-year lows recently. And so investors then, all the Japanese investors, they moved their capital out of Japan into other markets. I mean, the U.S. 10-year is paying around 4%. The Japanese 10-year pays a little over 1%. So that's a major difference. So investors would much rather buy the U.S. bond than the Japanese bond. But now, finally, we've seen the Bank of Japan, it raised rates this last week for the first time in 17 years. And the yen did move. It moved off those 35-year lows, and it's up about 7.5%. But it's still down. I mean, it's down 6% this year. It's down 14% since 2023 high, and down a whopping 30% since 2021. So it's starting to move, but it's still a long ways from where it was, and it's some mild relief for the Japanese consumer.
The BRIC countries are talking about bringing out a digital currency called the unit that will be 40% backed by gold. What's that going to do to other fiat currencies?
It's going to be interesting. All of these ideas for digital currencies, I think it's really going to depend how it's run. The reason people like Bitcoin and Ethereum is that you're pretty much anonymous. There's nobody able to track what you're doing. When we see these central banks wanting to do digital currencies, that's a whole different picture. The reason they want to do is they want to track what you're doing. They want to be able to tax what you're doing. A central bank has a digital currency. Well, they could just automatically tax you on every transaction you make. If you want to pay your babysitter, they could charge you, GST here. So there's that. So if somebody does come up with another way of doing it backed by gold or some other way, the fiat currencies, they're paper. They're based on just the faith that it's worth something to somebody else, but there's really nothing holding it and nothing supporting it. So, I'm very interested in these other kind of ideas. I certainly don't want to see a central bank digital currency.
Where can our listeners subscribe to the Trend Letter?
Well, they can just simply go to our website, The Trend Letter, so all one word, thetrendletter.com. We've got 4 services. So we got the Trend Letter. So 23 years we've been publishing that. So that comes out every Sunday evening, covers all the markets. We have Trend Technical Trader. So again, that's for active and long-term investors. Especially right now, it started out as a hedging service. So right now, its hedges are doing very well as the market is crapping out here. But it also does long positions. Again, similar. It covers equities, precious metals, commodities, and it also has our gold technical indicator, our proprietary. Then we have Trend Disruptors. So that's speculative, for risk capital. Services invest in disruptive technology. So AI, virtual, augmented reality, 5G cloud, all that cool stuff. And then we also have our free service. So that's Headline Service. And what we do there is every morning during the week, we scour the news from a business investment perspective. And then we send out headlines that we think every investor needs to be aware of. And then the readers can simply read the headline. And if they want more detail, they just click on the link and they can read the actual article. So again, people can just go to the trendletter.com. If you've got any questions, you can email us at info@thetrendletter.com.
Martin, thank you so much for being on This Week in Money.
Oh, always a pleasure, Jim. Enjoy the long weekend.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. Coming up, Robert Campbell, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter online at realestatetiming.com. He's speaking to us from San Diego. Bob, welcome back to This Week in Money.
Thank you very much, Jim.
When's the next issue of the Campbell Real Estate Timing Letter going to be published?
It will come out in September 15th. I just published the July 15th issue, and I publish it 6 times a year. Once every 2 months.
Where can people get your book, Timing the Real Estate Market?
At my website, realestatetiming.com. Realestatetiming.com. Exactly the way it sounds.
This week, the Fed left the bank rate unchanged. There's rumors the bank rate will be lowered at the September meeting of the Fed. Markets tend to move in waves. Do interest rates move in waves?
The word waves is... I'm not quite so sure that's the most accurate term, that interest rates move up and down because the economy moves up and down, and the Fed controls interest rates, at least short-term rates. So when the economy moves in waves, so when business gets bad, they lower interest rates. When business is good and inflation's high, they raise interest rates. So, I would say if you looked at it, based on that characteristic, it does move in waves.
Does the rate of inflation tend to move in waves?
Absolutely. Absolutely. And even though we don't have a lot of episodes to confirm that hypothesis, that if we only look back in the 70s, there was a period from about 65 through 81 that where you had a first wave up, then it came down. You had a second wave up, then it came down, and then you had a third wave up, then it came down, and each new wave had a higher high than the previous wave, and a higher low, and then finally the inflation was over in the 70s when Paul Volcker, the Fed chairman at the time, cranked interest rates up to whatever it was, 22% or something like that, and then inflation went away. Because nobody could afford anything. Nobody could afford to buy anything, so it killed demand.
Could there be a U.S. government Social Security debt bomb ahead?
There absolutely is a debt bomb ahead, and it's not so much Social Security as it is Medicare. Right now, Social Security, the tax revenues coming into Social Security, there's only a 15% shortfall of what's coming in versus what's going out. With Medicare, it's 80%, Jim. In other words, it's only being funded by 20%. What's going out right now is 80% greater than what's coming in. And the proverbial you-know-what should hit the fan in the next year or two because there's going to be no money. So, does that mean Medicare is not going to be given to Americans anymore? No. Doesn't mean that at all. What it means is the government is going to have to go deeper into debt to make those Medicare payments. And that's just more deficit spending, and it means more inflation.
What is the key real estate indicator you're focused on now?
That's a great question, and here it is. It's months of supply inventory for sale on the market. And that's right now the only reason that housing prices are still moving up modestly is because of the dynamics of supply and demand. Right now, that there still is a very low supply of homes on the market, even though demand is 30-40% off its old peaks. There's no supply. But that trend started changing about 6 months ago. And slowly, demand keeps falling and inventory on the market keeps increasing. A lot of people, however, make the mistake of focusing only on inventory. That's a big mistake because that by itself is not as well correlated with the peak of markets and price movement as is the months of supply on the market. And simply put, what months of supply on the market is this. That takes whatever the prevailing rate of existing home sales is, you divide that by the number of homes on the market. And right now in the United States, there's about a 3.7 month supply. In California, it's about a 2.7 month supply, which is very low. And until that number reaches 6, we're still going to have price appreciation.
Is peak pricing an indicator?
No. You can't call it. Yes, you know what? You can call peak pricing if you use a very reliable price pattern that I use all the time, that they learned about trading stocks, and it works so well. It's about 80% accurate, and it's 1, 2, 3 trend reversals. So peak pricing, here's how peak pricing would work. If prices went up and hit a peak of, let's say, $100,000, median price home was $100,000, and then started coming down. And then all of a sudden you had a reaction because people jump in thinking, the pricing goes down to $90,000 a home. People jump in and, thinking it's a bargain, and housing prices go up to 95. They don't take out the old peak at 100, but they go up to 95 before they start heading back down again. And soon as they go back down, under 90, which was the old low, there's an 80% chance that is a major trend reversal, and you should get out of that market. It works like magic.
Is affordability a thing of the past for real estate?
No, it's not a thing of the past. In fact, it's one of the key indicators that I focus on, and I'm focusing on even more exclusively right now. For example, let's use California. In California, going back to the 1970s, every time affordability has gotten to 17% or less, we've had a price correction, and sometimes a huge price correction. Right now, the low was 15 in California. We're at 17 right now. So we're in the process of forming a major cyclical peak right now, both in the U.S. and in the state of California. And, even if you just looked at affordability, if you only focused on that one indicator by itself, that would be a great, great indicator. Because you look at a chart going back 40, 50 years, when affordability, one thing affordability doesn't call the bottoms. It calls the tops. So, I guess you could use that one key indicator for the bottoms. You'd have to use, my other key indicators that I use, that signal the top.
Do slowing sales and rising inventory lead to the dropping of prices?
Yep. As long as the month supply of inventory on the market is once it gets above 6, but until it gets above 6, we're still going to have rising prices. And that 6, why is 6 such a magic number? I have no idea in the world. But if you go back and just look at what the numbers do, when it gets above 6, 93% of the time prices go down. When it's below 6, 100% of the time prices go up. So you have to respect that number.
When are huge price reductions likely to kick in?
The biggest price reductions are going to kick in, not initially, but they normally kick in after people have slowly come to the realization that we are now in the down cycle. We are now in a bust. Then people panic and start getting out. But at first, it happens kind of slowly because people don't believe it, or they don't want to believe it.
When huge price reductions kick in, do banks severely constrict lending?
Absolutely. One, because that at least historically, when they used to start getting banks, in the old days, let me talk about the old days, guys. Back when I first started in this business, 50 years ago, back in the old days, when the markets went down, foreclosures went up, and the banks started getting tons of property known as REOs, real estate owned. Back then, when a bank had an REO, and let's say that there was a $100,000 delinquent loan, there was something like you had to multiply that $100,000 times 10 and subtract that out of any future loans you would make. So in other words, when these things were piling up, that just by law, they couldn't make any new loans until they dumped the REOs. And of course, once you dump the REOs, what happens? Prices continue to go down. It's like pouring gasoline on a fire. So that goes down, and then they're getting more and more properties back. So foreclosures fuel more foreclosures, and then eventually, the market hits the bottom. But those were the old days when it significantly restricted lending. Today, I don't know. It's so political, everybody. They changed it and said, you don't even have to count REOs. In fact, back in the old days, the banking system, once you have an REO, a real estate owned on the books, you're in the lending, not the property, owning property business. You had something like 90 or 120 days to get rid of the property. Today, I know they relaxed all those rules. They can hold on to those properties forever. So, in many ways, that's what supported the high prices that we have right now, because the marking down of prices because of the foreclosures was significantly reduced, and the banks didn't have to dump all their on the market.
As the housing market turns from bull to bear, what happens to the psychology of buyers and sellers?
That is 50% of price movement is based on market psychology. And when prices are going up, everybody's bullish, and everybody feels good. They feel like buying, and it's a very positive, optimistic mood. When prices start going down, it's exactly the opposite. It's the behavior of the crowd, the mood changes, and that in itself adds to the economic fundamentals that bring prices down, such as, foreclosures hitting the market at an accelerating rate. So it's a beautiful thing, really. I mean, you see that, and it's called behavioral economics. The economist Thaler won a Nobel Prize for that. The Yale economist Robert Shiller won a Nobel Prize for that. There's only been 3 recognized Nobel Prizes given for behavioral economics, but it's a fascinating study, and it's 100% true.
What do housing crashes do to the economy?
They make the economy contract. For one thing, new home construction accounts for anywhere between 15 and 20% of the U.S. economy. When housing prices are crashing, home building crashes. And there's 15% to 20% of the economy that goes down the drain with it. And so that's what takes the economy down. Interestingly, once the down cycle has been completed and housing, and all of a sudden prices aren't falling anymore, and slowly but surely builders are starting to bring more inventory, build more homes, that's a key indicator to watch. That's what takes the U.S. economy out of recession. New home building is a major, major business, guys. 15 to 20% of the U.S. economy, all told. What happens? So, I mean, you lose something significant, because it's not rare that new home building, at least in places like California where the cycles are very volatile, new home building can drop 20, 30, 40%. That takes the economy right down with it.
Where are the bubble cities in America, and when the bubble bursts, what's likely to happen to home prices in those bubble cities from the low, mid, and high ends? Okay,
in my last issue, I did I made some forecasts based on mean reversions of how far housing prices are going to fall in both California, where most of my subscribers are, and in the United States in general. And based on the mean reversion going back 40 years, that identifies market cycle bottoms, I figured that U.S. housing prices are going to drop, I think it's like 37 to 38%, and California is going to drop somewhere in the low 40s. And just as a state. Now, which cities which cities are most vulnerable to price corrections during this bubble, which is bigger than the last bubble that peaked in 2005, 2006. All cities in California, every single one of them. I mean, maybe not the Central Valley. Central Valley is, that's a whole different animal than what goes on the coast, in San Francisco, Los Angeles, Orange County, San Diego, San Jose. But and that's where all the homes are, of course. That's where all the people live. They live on in the coast. They don't live in Chico or Fresno or Modesto. But so those areas will hold up a little better, but they'll still come crashing down. So all the California cities are going to be a crash. In the United States, what other cities are most vulnerable? Seattle, Miami, Tampa, Dallas, Denver, Phoenix, Las Vegas. They're all going to come down. But if you had to name, say, okay, which ones do you think are going to have the most severe markdowns? It would be those cities. And everybody was all, breathing hard about, all the opportunity in Florida, that everybody's moving to Florida because they don't have any state income tax, and, all the seniors are moving there, and the business is going to be good because all the seniors require health care workers, and there's no homes for them to live in or apartments, so we need to keep building. And it's, it's like, a real estate investor's dream, what's going to happen to property values in Florida, or at least as the spokesman for the industries would say. Inventory is picking up dramatically in Florida right now. So Florida's going to have its huge bust too. Nobody's immune from this. This kind of thing. So I think Florida's going to get hit really hard too.
Are there triggers to watch out for that indicate an impending waterfall in home prices?
Sure. I mean, that we talked about one of the indicators, and that's housing affordability. And you just look at a chart going back 40, 50 years and say, okay, when affordability gets to this level or below, what happens? Prices go down. How often does that happen? Every time. Does it happen does it happen by the same magnitude in every city? No. I mean, like some places like Oklahoma City. Now, you could buy real estate in Oklahoma City, and you buy Oklahoma City, and that's for cash flow. In a boom, housing prices will go up 4 or 5% a year. In a bust, they'll go down 2 or 3% a year. So, the price risk is very, very minimal, but there's no price appreciation long term. You're buying cash flow. So some of those areas, so what triggers to watch out for? Housing affordability is a huge one. Existing home sales is a huge one. New home building permits is huge. Notice of defaults on mortgages is huge. Foreclosures is huge. And surprisingly, everybody focuses on interest rates, mortgage rates. That's one of the least significant indicators that I focus on because it has minimal impact or correlation with price movement. Housing prices can go up in rising interest rates, and they can go down in falling interest rates, and the charts prove it.
When it's a cash buyer's market for homes, is it a sign the market is hitting bottom?
No, to turn into a cash market, that's a pretty extreme case. And cash markets typically develop, let's say inflation gets out of control. Let's say inflation in the United States goes to 50%. I mean, would that raise any eyebrows in the scheme of the whole world and inflation? No, not at all. Not at all. And so what happens during extreme inflation, if you have 40% inflation, mortgage rates are going to be 50%. Okay, they're going to split. But are you going to find a mortgage lender that's going to lend you a 30-year loan at 40%, at 50% interest rate with inflation going off at 40? No, you're not. So in other words, there is no credit financing. Credit dries up, and the real estate market is driven by credit. And I learned about this situation by studying, reading a few books, what's happened during the inflation in Argentina. And what happened, of course, they have the Argentine peso, they have two money systems, the Argentine peso and the U.S. dollar. But essentially what happened, that when there was no financing available and you wanted to sell your house, The only person you're going to sell it to is a cash buyer. A cash buyer. And that price is going to be significantly less than you could getting a mortgage. So there's a short period of time, maybe up to a year, where the market is so bad, anybody with cash can step in and buy real estate at 20, 30 cents on the dollar.
Should mental fitness and physical fitness be an important focus during tough real estate times?
Physical and mental fitness, everybody, are important all the time. All the time. But especially during tough times, like during down markets. You have to have the mental fitness to say that nothing can beat me, nothing can get me down, and you got to believe it. It can't be a bunch of crap that, you just make affirmations to yourself that you're the toughest guy. Just say over and over again, I'm the toughest guy in the world, nothing can happen to me. You really have to be the toughest guy in the world. And you develop that mental fitness, that mental strength that you can overcome anything, and it all starts with physical fitness. It all starts with that. Once you have physical fitness, you can develop mental fitness. And I've learned the benefits of that maybe only 5 years ago, guys. I've always been a really, had strong mental strength, but that in the last 5 years, I would say it's 5 times stronger than it's ever been in my life. And you develop it. And you can develop that mental strength by doing things that you never thought that you could do. And I started developing that in the gym. I had a trainer. We would do certain things like we say, okay, that we push it. I'm going to do military presses. I'm going to use a 70-pound weight, and I'm going to do 3 reps, sets of 8 reps. Okay, bang, bang, bang. I went in the gym one day, and then my trainer said, hey, we're going to do 10 reps. I go, I can't do that. 3 reps, I'm already exhausted, falling on the ground. He said, we're going to do 10 today. And I said, I can't do it. He goes, you can do it. And he made me do it, and I did it. And you know what, afterwards? It was like, was that really that hard? No. And that's how you develop the mental. One of the ways to develop the mental strength, guys, to do things that you never thought you could do, to take risks, good risks that you thought that you shouldn't take because you're afraid to take them, or that you can't do this. What I always used to teach my kids, you don't know if you don't try. Now, you shouldn't jump off 20-story buildings thinking you can fly. That's crazy. But like doing physical things like that, like maybe that I can go out there and buy a piece of real estate at the bottom of the market at 50% under market. A lot of that's mental strength, guys. If you believe you can do it, you can do it. If you believe you can't do it, you won't do it. And so you develop that mental strength, and you do it by pushing your limits on a lot of things. Other things, maybe it's playing sports. Maybe it's hitting a baseball 300 feet. And before you could only hit a baseball, 275 feet. How do you do it? You develop the skill. I can do that. I can do that. And pretty soon you have that mental strength that you're almost invincible. Are you going to fail? Yeah. Are you going to be successful more than you fail? Yeah, you are. And so it's all important.
Bob, where can people follow you, buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
They can go to my website, realestatetiming.com. And also, some of you, if you enjoyed my attitude on life and my approach to the markets, you should go to my website and sign up for my blog. I publish a blog post about once every week. And about 50% of the time, it's on economics and real estate. And the other 50% of the time, it's on health and fitness and whatever else I want to talk about. So most people find that I'm a real balanced individual. I do things that people my age don't even think about doing. And not to brag, but a lot of people find me a real inspiration. Because not only do I talk the talk, I walk the walk, and it's nice to help people, show them that, hey, if I can do it, you can do it.
Bob, thank you so much for being on This Week in Money.
You're welcome, Jim.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter. He was speaking to us from San Diego. And that wraps up our show for today. We'd like to thank our guests, Ross Clark, Tim Cyclesman Wood, Martin Straith, and Robert Campbell. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.